Today we have Ben Kawala here sharing with us the changes from the One Big Beautiful Bill Act affecting California homeowners. Ben, take it away, please.
All right. So one of the biggest changes was the changes to SALT, which stands for state and local taxes. So before the Tax Cuts and Jobs Act of 2017, there was no limit on the deductions for state and local taxes on the Schedule A as an itemized deductor. So that meant that your state income taxes, your property taxes, DMV fees, which are a personal property tax, all of that could be taken in full before the Tax Cuts and Jobs Act. The Tax Cuts and Jobs Act slashed that to $10,000, which heavily affected people that are in a high state income tax and property tax states like California, New York, some other states where there's very high taxes. So you might have had an $80,000 deduction in 2016, then it was limited to $10,000 in 2017. So that hurt a lot of California taxpayers. The One Big Beautiful Bill Act, they increased the SALT limitation from 10,000 to 40,000. And that is actually going to adjust for inflation every year. So it'll be a little bit more than 40,000 in 2026, but then it's set to expire after 2029. So that was only made temporary. It's supposed to go back down to $10,000 after 2029. So it's temporary, but we'll see what happens down the road because there might be new administration, what have you, that can always change the laws from there. So before there was a bigger benefit to homeownership for most people because there was no limit on your state and local tax, and the standard deduction was a lot lower. Another effect of the Tax Cuts and Jobs Act, which was expanded under the One Big Beautiful Bill Act, was the doubling of the standard deduction for all taxpayers. So your itemized deductions only benefit you to the extent that you exceed the standard deduction, because the standard deduction is free to everybody. So if you're a married couple and let's say you round to you have a $30,000, it's a bit more than that, but $30,000 standard deduction, and your state and local taxes plus your mortgage interest plus your charitable contributions bring you to 40,000, only 10,000 of all those are really to your benefit because the first 30,000 was already a free handout from the government. So if you're capped at $10,000 SALT and your mortgage interest was $20,000, you're not getting any benefit from the homeownership, assuming no other deductions. But now, with the increase of the SALT to 40,000, there's probably going to be a lot of California homeowners that are at or exceeding the $40,000 limit just because of how high the state income tax and property taxes are. So if you max that out at 40,000, you're already going to be over the standard deduction. But even for a married couple, 65 plus, where they have the maximum itemized deductions, it's going to exceed the $40,000. Although I should probably put an asterisk on that because one change of the One Big Beautiful Bill Act was if you're 65 plus, you get an extra $6,000 deduction on top of the standard deduction for each taxpayer. So a married filing joint couple will get an extra $12,000 on top of the standard deduction, but that does start to phase out once your adjusted gross income is over 75,000 single, 150,000 joint. So there's some specifics to look into that. But for the typical standard deduction, you would exceed that with a 40,000, and that means that not only is your property tax working more for you on your itemized, but your mortgage interest might be working for you in its entirety. If you're already at the 40,000, then all the mortgage interest is now helping you. So it's better for homeowners now under the One Big Beautiful Bill Act than it was under the Tax Cuts and Jobs Act.
So let's use an example. Let's say someone has $20,000 a year in property taxes, and let's say $70,000 a year in mortgage interest from their home. Can they deduct, or can they use 100% of that 90,000 combined to offset their current income?
So if they have 70,000 in mortgage interest, then it's almost certain that their mortgage is more than 750,000. So one change that was made under the Tax Cuts and Jobs Act, which was made permanent under the One Big Beautiful Bill Act, was limiting the deductibility of mortgage interest when your outstanding mortgage is over 750,000. Even before the Tax Cuts and Jobs Act, it was limited to $1 million. They lowered it from $1 million to 750. So if your outstanding mortgage is $1 million, then only 75% of your mortgage interest would be deductible.
Got it.
Now, each year as you're paying down principal, then you're able to deduct more of your mortgage interest as your loan balance decreases. But if it's over 70,000, then it is limited. I've had interesting cases where there have been unmarried couples who own a property together who were putting off getting married because they own 50-50 and their property, let's say that their mortgage was 1.5 million. So they're able to, on their respective single tax returns, take the full deduction for mortgage interest based on that $72,000 limit. But if they got married, the 750 limit is not per taxpayer, it's per tax return. So their mortgage interest deduction would cut in half if they got married. So yeah, that's could be a consideration for some people.
Okay, so let's say that they meet their mortgage balance is below 750,000. Let's say their property tax is 10,000, and then their mortgage interest is 30,000, and it's below $750,000 mortgage balance. Are they able to deduct all of that?
Yes. Also, you don't want to ignore their state income tax, whatever their state withholding is. Let's say that is another 15,000. So they have, 25,000 total state and local taxes between their state income tax and their property tax and, some DV fees or what have you. That would still be at their standard deductions. Well, for a married couple, if they're single, then they'll be over the standard deduction. Because that's about, for 2025, the standard deduction for single is at 15,750. For married, it's 31,500. So if they're single, they're already above the standard deduction there, and then any additional deductions are just gravy on top. So the full mortgage interest would be deductible.
Okay, got it. All right. So Ben, would you also talk a little bit about tax deductions versus tax credit? I think a lot of people misunderstand that if they get $40,000 in SALT, that means that they don't have to pay $40,000 in taxes. That they think it's a dollar for dollar. Would you expand on that?
So deductions reduce your taxable income. Credits reduce your tax. So if you have $100,000 taxable income before accounting for deductions, and you have $20,000 deductions, reducing your taxable income to $80,000, that does not mean you pay $20,000 less in taxes. It means that whatever your tax brackets are between federal and state, let's just say that those are at 30% combined, then you're saving yourself 30% of that $20,000 on taxes. Credits reduce your tax dollar for dollar. So common credits include child tax credit, energy credits, education credits. Those, if you have a $2,000 child tax credit, it reduces your tax bill by $2,000. Usually credits are less generous because as far as the IRS doesn't give as many credit options as they do for deductions, because they, again, reduce your tax dollar for dollar.
Okay. So the tax deduction is to reduce the taxable income. And then whatever that tax bracket lands you in, your adjusted gross income lands in, that's the tax rate that you'll be using. So it doesn't actually adjust. Tax deductions does not reduce your tax liability dollar for dollar. It just changes your tax bracket.
Correct.
Okay.
So it doesn't necessarily change your tax bracket. You might fall into a lower tax bracket with the deductions, but the tax savings is based on whatever brackets to determine your tax percentage.
Okay, great. That wraps it up for this segment of changes from the One Big Beautiful Bill Act for California homeowners. Thank you, Ben. Real estate is a great way to build wealth tax efficiently. Knowing the rules is the first step, and the next step is taking action. Plan your strategy with Ben Koala, our expert CPA, financial planner, and attorney. You can find his direct contact information displayed on your screen now, as well as a direct link in the show notes below. For questions on real estate financing and loans, reach out to us directly at Abundance. We serve real estate investors in over 40 states by accessing capital from more than 30 different wholesale lenders. We do the shopping and managing the process for you, so you can focus on acquisitions and asset management. If you found this information valuable, please hit the like button and subscribe. We will see you in the next segment.